Good day, class. We will discussing today about planning and organizing a business. What is business planning? It is also a roadmap that provides directions so a business can plan its future and helps it avoid bumps in the road. The time you spend making your business plan thorough and accurate, and keeping it up to date, is an investment that pays big dividends in the long term. Other definition of business planning are: business planning is an important precursor to action in new ventures. By helping firm founders to make decisions, to balance resource supply and demand, and to turn abstract goals into concrete operational steps, business planning reduces the likelihood of venture disbanding and accelerates product development and venture organizing activity. By Delmar and Shane, 2003, p. 1165. We always plan too much and always think too little. We resent a call to thinking and hate unfamiliar argument that does not tally with what we already believe or would like to believe. By Joseph Schumpeter. Trying to predict the future is like trying to drive down a country road at night with no lights while looking out the back window. By Peter Drucker. Business planning purposes. Business plans are developed for both internal and external purposes. Internally, entrepreneurs develop business plans to help put the pieces of their business together. The most common external purpose for a business plan is to raise capital. Internal purposes. External purposes. Internal purposes. The business plan is the roadmap for the development of the business because it defines the vision for the company. Establishes the company's strategy. Describes how the strategy will be implemented. Provides a framework for analysis of key issues. Provides a plan for the development of the business. Is a measurement and control tool. Helps the entrepreneur to be realistic and to put theories to the test. External purposes. The business plan is often the main method of describing a company to external audiences such as potential sources for financing and key personnel being recruited. It should assist outside parties to understand the current status of the company, its opportunities, and its needs for resources such as capital and personnel. It also provides the most complete source of information for valuation of the business. Business planning principles. Business plan communication principles. Business plan credibility principles. Business plan communication principles. As HINDLE and MAINPRIZE, 2006, note, business plan writers must strive to communicate their expectations about the nature of an uncertain future. However, the liabilities of newness make communicating the expected future of new ventures difficult, more so than for existing businesses. HINDLE and MAINPRIZE 5 Communications Principles. Expectations. Milestones. Opportunities. Context. Business model. Expectations. Translation of your vision of the venture and how it will perform into a format compatible with the expectations of the readers. Communicate that you have identified and understood the key success factors and risks. The projected market is large and you expect good market penetration. You have a strategy for commercialization, profitability, and market domination. You can establish and protect a proprietary and competitive position. Milestones. Anchoring key events in the plan with specific financial and quantitative values. Communicate that your major plan objectives are in the form of financial targets. You have addressed the dual need for planning and flexibility. You understand the hazards of neglecting linkages between certain events. You understand the importance of quantitative values, rather than just chronological dates. Opportunities. Nothing lasts forever. Things can change to impact the opportunity, tastes, preferences, technological innovation, competitive landscape. Communicate these four aspects to distinguish the business concept, distinctive competencies, and sustainable advantages. The new combination upon which venture is built. Magnitude of the opportunity or market size. Market growth trends. Venture's value from the market, percent of market share proposed or market share value in dollars. Context. Four key aspects describing context within which new venture is intended to function: internal and external environment. Communicate. How the context will help or hinder the proposal. How the context may change and affect the business and the range of flexibility or response that is built into the venture. What management can or will do in the event the context turns unfavorable. What management can do to affect the context in a positive way. Business model. Brief and clear statement of how an idea actually becomes a business that creates value. Communicate. Who pays, how much, and how often. The activities the company must perform to produce its product, deliver it to its customers and earn revenue. And be able to defend assertions that the venture is attractive and sustainable and has a competitive edge. Business plan credibility principles. Business plan writers must strive to project credibility, HINDLE and MAINPRIZE, 2006, so there must be a match between what the technopreneurship team, resource seekers, needs and what the investors, resource providers, expect based on their criteria. A take-it-or-leave-it approach, example, financial forecast set in concrete, by the technopreneurship team has a high likelihood of failure in terms of securing resources. HINDLE and MAINPRIZE, 2006, 5 Principles Project Credibility. Team. Elaboration. Scenario integration. Financial link. The deal. Team. Without the right team, nothing else matters. Communicate. What do they know? Who do they know? How well are they known? Elaboration. Break down individual tasks into their subparts so each step maximizes the upside and minimizes the downside. Sub-strategies. Ad hoc programs. Specific tactical action plans. Scenario integration. Claiming an insuperable lead or a proprietary market position is naive. Venture building is like chess. Anticipate several moves in advance. View the future as a movie versus snapshot. Financial link. Key assumptions related to market size, penetration rates, and timing issues of market context outlined in the business plan should link directly to the financial statements. Income and cash flow statements must be preceded by operational statements setting forth the primary planning assumptions about market sizes, sales, productivity, and basis for the revenue estimate. The deal. If the main purpose is to enact a harvest, then the business plan must create a value-adding deal structure to attract investors. Common things: viability, profit potential, downside risk, likely life cycle time, potential areas for dispute or improvement. General business plan guidelines. Many businesses must have a business plan to achieve their goals. The following are some basic guidelines for business plan development. A standard format helps the reader understand that the entrepreneur has thought everything through, and that the returns justify the risk. Binding the document ensures that readers can easily go through it without it falling apart. Be 100% certain at all times. Be 100% certain that everything is completely integrated. The written part must say exactly the same thing as the financial part. All financial statements are completely linked and valid. Make sure all balance sheets validly balance. The document is well formatted. Layout makes document easy to read and comprehend, including all diagrams, charts, statements, and other additions. Everything is correct. There are no spelling, grammar, sentence structure, referencing, or calculation errors. The document easy to read and comprehend because it is organized well with no unnecessary repetition. Credibility is both established and maintained if a statement is included that presents something as a fact when this fact is not generally known. Always indicate the source. Unsupported statements damage credibility. Be specific. A business plan is simply not of value if it uses vague references to high demand, carefully set prices, and other weak phrasing. It must show hard numbers, properly referenced, of course, actual prices, and real data acquired through proper research. This is the only way to ensure your plan is considered credible. The stages of development. In the figure shown, Business Plan Development Process illustration by Lee A. Swanson. There are 6 stages involved with developing a high-power business plan. Essential initial research stage. Business model stage. Initial business plan draft stage. Making the business plan realistic stage. Making a plan to appeal to stakeholders stage. Finishing the business plan. These stages can be compared to a process for hosting a dinner for a few friends. A host hoping to make a good impression with their anticipated guests might analyze the situation at multiple levels to collect data on new alternatives for healthy ingredients, what ingredients have the best prices and are most readily available at certain times of year, the new trends in party appetizers, what food allergies the expected guests might have, possible party themes to consider, and so on. This analysis is the essential initial research stage. In the business model stage, the host might construct a menu of items to include with the meal along with a list of decorations to order, music to play, and costume themes to suggest to the guests. The mix of these kinds of elements chosen by the host will play a role in the success of the party. The initial business plan draft stage is where the host rolls up his or her sleeves and begins to make some of the food items, put up some of the decorations, send invitations, and generally get everything started for the party. During this stage, the host will begin to realize that some plans are not feasible and that changes are needed. The required changes might be substantial, like the need to postpone the entire party and ultimately start over in a few months, or less drastic, like the need to change the menu when an invited guest indicates that they can't eat food containing gluten. These changes are incorporated into the plan to make it realistic and feasible in the making the business plan realistic stage. Making a plan to appeal to stakeholders stage involves further changes to the party plan to make it more appealing to both the invited guests and to make it a fun experience for the host. For example, the host might learn that some of the single guests would like to bring dates and others might need to be able to bring their children to be able to attend. The host might be able to accommodate those desires or needs in ways that will also make the party more fun for them, maybe by accepting some guests' offers to bring food or games, or maybe even hiring a babysitter to entertain and look after the children. The final stage, finishing the business plan, involves the host putting all of the final touches in place for the party in preparation for the arrival of the guests. Essential initial research. A business plan writer should analyze the environment in which they anticipate operating at each of the societal, industry, market, and firm levels of analysis. This stage of planning, the essential initial research, is a necessary first step to better understand the trends that will affect their business and the decisions they must make to lay the groundwork for, and to improve their potential for success. In some cases, much of the essential initial research should be included in the developing business plan as its own separate section to help build the case for readers that there is a market need for the business being considered and that it stands a good chance of being successful. In other cases, a business plan will be stronger when the components of the essential initial research are distributed throughout the business plan as a way to provide support for the plans and strategies outlined in the business plan. For example, the industry or market part of the essential initial research might outline the pricing strategies used by identified competitors and might be best placed in the pricing strategy part of the business plan to support the decision made to employ a particular pricing strategy. Business model. Inherent in any business plan is a description of the business model chosen by the entrepreneur as the one that they feel will best ensure success. Based upon their essential initial research of the setting in which they anticipate starting their business, their analysis from stage 1, an entrepreneur should determine how each element of their business model, including their revenue streams, cost structure, customer segments, value propositions, key activities, key partners, and so on, might fit together to improve the potential success of their business venture. For some types of ventures, at this stage an entrepreneur might launch a lean startup, see page 68, and grow their business by continually pivoting, or constantly adjusting their business model in response to the real-time signals they get from the market's reactions to their business operations. In many cases, however, an entrepreneur will require a business plan. In those cases, their initial business model will provide the basis for that plan. Of course, throughout this and all of the rounds in this process, the entrepreneur should seek to continually gather information and adjust the plans in response to the new knowledge they gather. As shown in Figure 8 by its enclosure in the progressive research box, the business plan developer might need conduct further research before finishing the business model and moving on to the initial business plan draft. Initial business plan draft. The business plan draft stage involves taking the knowledge and ideas developed during the first two stages and organizing them into a business plan format. The approach preferred by many is to create a full draft of the business plan with all of the sections, including the front part with the business description, vision, mission, values, value proposition statement, preliminary set of goals, and possibly even a table of contents and lists of tables and figures, all set up using the software features enabling their automatic generation. Writing all of the operations, human resources, marketing, and financial plans as part of the first draft ensures that all of these parts can be appropriately and necessarily integrated. The business plan will tell the story of a planned business startup in two ways: by using primarily words along with some charts and graphs in the operations, human resources, and marketing plans, and in a second way through the financial plan. Both ways must tell the same story. The feedback loop shown in figure shown demonstrates that the business developer may need to review the business model. Additionally, as shown by its enclosure in the progressive research box, the business plan developer might need conduct further research before finishing the initial business plan draft stage and moving on to the making business plan realistic stage. Making business plan realistic. The making business plan realistic stage has two possible feedback loops. The first goes back to the initial business plan draft stage in case the initial business plan needs to be significantly changed before it is possible to adjust it so that it is realistic. The second feedback loop circles back to the business model stage if the business developer need to rethink the business model. The first draft of a business plan will almost never be realistic. As the entrepreneur writes the plan, it will necessarily change as new information is gathered. Another factor that usually renders the first draft unrealistic is the difficulty in making certain that the written part in the front part of the plan along with the operations, human resources, and marketing plans tells the exact same story as the financial part does. This stage of work involves making the necessary adjustments to the plan to make it as realistic as possible. Making plan appeal to stakeholders and desirable to the technopreneur. A business plan can be realistic without appealing to potential investors and other external stakeholders, like employees, suppliers, and needed business partners. It might also be realistic, and possibly appealing to stakeholders, without being desirable to the technopreneur. During this stage, the technopreneur will keep the business plan realistic as they adjust plans to appeal to potential investors and to themselves. The caution with this stage is to balance the need to make realistic plans with the desire to meet the technopreneur's goals while avoiding becoming discouraged enough to drop the idea of pursuing the business idea. If, for example, investors will be required to finance the business start, some adjustments might need to be relatively extensive to appeal to potential investors' needs for an exit strategy from the business, to accommodate the rate of return they expect from their investments, and to convince them that the technotrepreneur can accomplish all that is promised in the plan. In this case, and in others, the technotrepreneur will also need to get what they want out of the business to make it worthwhile for them to start and run it. So, this stage of adjustments to the developing business plan might be fairly extensive, and they must be informed by a superior knowledge of what targeted investors need from a business proposal before they will invest. They also need to be informed by a clear set of goals that will make the venture worthwhile for the technotrepreneur to pursue. It indicates that the business plan writer might need to adjust the draft business plan while ensuring that it is still realistic before it can be made appealing to the targeted stakeholders and desirable to the technotrepreneur. The second feedback loop indicates that it might be necessary to go all the way back to the business model stage to re-establish the framework and plans needed to develop a realistic, appealing, and desirable business plan. Additionally, this stage's enclosure in the progressive research box suggests that the business plan developer might need conduct further research. Finishing the business plan. The final stage involves putting all of the important finishing touches on the business plan so that it will present well to potential investors and others. This involves making sure that the math and links between the written and financial parts are accurate. It also involves ensuring that all the needed corrections are made to the spelling, grammar, and formatting. The final set of goals should be written to appeal to the target readers and to reflect what the business plan says. An executive summary should be written and included as a final step. Business plan overview. Most business plans have several distinct sections. The business plan can range from a few pages to 25 pages or more, depending on the purpose and the intended audience. For our discussion, we'll describe a brief business plan and a standard business plan. If you are able to successfully design a business model canvas, then you will have the structure for developing a clear business plan that you can submit for financial consideration. These are the following: executive summary, business description, marketing strategy, marketing plan, competitive analysis, operations and management plan, financial analysis, design and development plan. Executive summary. The executive summary should provide an overview of your business with key points and issues. Can be longer than normal executive summaries, up to 3 pages. Right after remainder of plan is complete. Includes information relevant to targeted readers, as this is the place where they are most likely to form their first impressions of the business idea and decide whether they wish to read the rest of the plan. The summary or statement should be no more than half a page in length and should touch on the following key elements. Business concept describes the business, its product, the market it serves and the business competitive advantage. Financial features include financial highlights, such as sales and profits. Financial requirements state how much capital is needed for startup or expansion, how it will be used and what collateral is available. Current business position furnishes relevant information about the company, its legal form of operation, when it was founded, the principal owners and key personnel. Major achievements points out anything noteworthy, such as patents, prototypes, important contracts regarding product development, or results from test marketing that have been conducted. Business description. This section describes the industry, your product, and the business and success factors. It should provide a current outlook as well as future trends and developments. Describes the company's mission, vision, goals, and objectives. Summarize your overall strategic direction, your reasons for starting the business, a description of products and services, business model, and company's value proposition. The business description usually begins with a short explanation of the industry. When describing the industry, discuss what's going on now as well as the outlook for the future. Do the necessary research so you can provide information on all the various markets within the industry, including references to new products or developments that could benefit or hinder your business. Base your observations on reliable data and be sure to footnote and cite your sources of information when necessary. Remember that bankers and investors want to know hard facts. They won't risk money on assumptions or conjecture. When describing your business, say which sector it falls into: wholesale, retail, food service, manufacturing, hospitality, and so on, and whether the business is new or established. Then say whether the business is a sole proprietorship, partnership, corporation. Next, list the business principles and state what they bring to the business. Continue with information on who the business customers are, how big the market is, and how the product or service is distributed and marketed. Marketing strategy. It refers to a business's overall game plan for reaching prospective consumers and turning them into customers of the products or services the business provides. It contains the company's value proposition, key brand messaging, data on target customer demographics, and other high-level elements. It is a long-term, forward-looking approach and an overall game plan of any organization or any business with the fundamental goal of achieving a sustainable competitive advantage by understanding the needs and want of customers. The business description can be a few paragraphs to a few pages in length, depending on the complexity of your plan. If your plan isn't too complicated, keep your business description short, describing the industry in one paragraph, the product in another, and the business and its success factors in 2 or 3 more paragraphs. When you describe your product or service, make sure your reader has a clear idea of what you're talking about. Explain how people use your product or service and talk about what makes your product or service different from others available in the market. Be specific about what sets your business apart from those of your competitors. Then explain how your business will gain a competitive edge and why your business will be profitable. Describe the factors you think will make it successful. If your business plan will be used as a financing proposal, explain why the additional equity or debt will make your business more profitable. Give hard facts, such as new equipment will create an income stream of $10,000 per year, and briefly describe how. Other information to address here is a description of the experience of the other key people in the business. Whoever reads your business plan will want to know what suppliers or experts you've spoken to about your business and their response to your idea. They may even ask you to clarify your choice of location or reasons for selling this particular product. Marketing plan. It is an operational document that outlines an advertising strategy that an organization will implement to generate leads and reach its target market. It contains a list of actions. Without a sound strategic foundation, it is of little use to a business. The functions and components of a marketing plan include the following: market research to support pricing decisions and new market entries. Tailored messaging that targets certain demographics and geographic areas. Platform selection for product and service promotion: digital, radio, internet, trade magazines, and the mix of those platforms for each campaign. Metrics that measure the results of marketing efforts and their reporting timelines. A marketing plan is based on a company's overall marketing strategy. Competitive analysis. It is a critical part of company business plan. With this evaluation, it can establish what makes your product or service unique and therefore what attributes it play up in order to attract the target market. It is a strategy where you identify major competitors and research their products, sales, and marketing strategies. A competitive analysis helps you learn the ins and outs of how your competition works. It also helps you identify what they're doing right and opportunities where you can easily one-up them by using a strategy they haven't taken advantage of. Every brand can benefit from regular competitor analysis. By performing a competitor analysis, you'll be able to identify gaps in the market, develop new products and services, uncover market trends, market and sell more effectively. As you can see, learning any of these 4 components will lead your brand down the path of achievement. But before you get too excited to start, we need to nail down a few important basics. Once you identify your true competition, you'll need to determine what metrics you'll be comparing across the board. Below, we'll give 9 specific factors to compare and tips on how to identify this competition in the first place. The purpose of the competitive analysis is to determine the strengths and weaknesses of the competitors within your market, strategies that will provide you with a distinct advantage, barriers that can be developed to prevent competition from entering your market, any weaknesses that can be exploited in the product development cycle. The first step in a competitor analysis is to identify both direct and indirect competition for your business, both now and in the future. Once you've grouped your competitors, start analyzing their marketing strategies and identifying their vulnerable areas by examining their strengths and weaknesses. This will help you determine your distinct competitive advantage. Whoever reads your business plan should be very clear on who your target market is, what your market niche is, exactly how you'll stand apart from your competitors, and why you'll be successful doing so. Operations and Management Plan. It describes how your business operates on a continuing basis. It describes the outline how you will manage your company. Describe its organizational structure. It also include an organizational chart/structure. Highlight the backgrounds, experiences, qualifications, areas of expertise, and roles of members of the management team. This is also the place to mention any other stakeholders, such as a board of directors or advisory board, and their relevant relationship to the founder, experience and value to help make the venture successful, and professional service firms providing management support, such as accounting services and legal counsel. The operations and management component of your plan is designed to describe how the business functions on a continuing basis. The operations plan highlights the logistics of the organization, such as the responsibilities of the management team, the tasks assigned to each division within the company, and capital and expense requirements related to the operations of the business. Financial analysis. It is the process of evaluating businesses, projects, budgets, and other finance-related transactions to determine their performance and suitability. It involves using financial data to assess a company's performance and make recommendations about how it can improve going forward. Financial analysis is used to evaluate economic trends, set financial policy, build long-term plans for business activity, and identify projects or companies for investment. This is done through the synthesis of financial numbers and data. A financial analyst will thoroughly examine a company's financial statements, the income statement, balance sheet, and cash flow statement. Financial analysis can be conducted in both corporate finance and investment finance settings. One of the most common ways to analyze financial data is to calculate ratios from the data in the financial statements to compare against those of other companies or against the company's own historical performance. For example, return on assets, ROA, is a common ratio used to determine how efficient a company is at using its assets and as a measure of profitability. This ratio could be calculated for several companies in the same industry and compared to one another as part of a larger analysis. Design and development plan. It is a section of a business plan talks about the product's design, development as well as the production process, marketing strategy, and the business itself. It provides investors with a description of the product's design, chart its development within the context of production, marketing, and the company itself, and create a development budget that will enable the company to reach its goals. There are generally 3 areas you'll cover in the development plan section: product development, market development, organizational development. Each of these elements needs to be examined from the funding of the plan to the point where the business begins to experience a continuous income. Although these elements will differ in nature concerning their content, each will be based on structure and goals. Types of business ownership. The business structure you choose influences everything from day-to-day operations, to taxes, to how much of your personal assets are at risk. You should choose a business structure that gives you the right balance of legal protections and benefits. There are basically 3 types or forms of business ownership structures for new small businesses: sole proprietorship, partnership, corporation. Sole proprietorship. A sole proprietorship is easy to form and gives you complete control of your business. You're automatically considered to be a sole proprietorship if you do business activities but don't register as any other kind of business. Sole proprietorships do not produce a separate business entity. This means your business assets and liabilities are not separate from your personal assets and liabilities. You can be held personally liable for the debts and obligations of the business. Sole proprietors are still able to get a trade name. It can also be hard to raise money because you can't sell stock, and banks are hesitant to lend to sole proprietorships. Sole proprietorships can be a good choice for low-risk businesses and owners who want to test their business idea before forming a more formal business. Advantages to having a sole proprietorship include: this type of business costs the least and is simple to begin. The sole proprietor has total control over the business and can make decisions that are best for the enterprise. The sole proprietor owns all the income from the business and can reinvest or retain it. The money that the business makes goes directly to the owner's personal tax return. It's easy to end the business. Disadvantages to having a sole proprietorship include: any debts that form are the responsibility of the sole proprietor. All personal and business assets are at risk. They can only use money from consumer loans or personal funds to advance the business. It might be difficult to attract high-quality employees. Not all employee benefits are available in a sole proprietorship. Partnership. Partnerships are the simplest structure for 2 or more people to own a business together. There are 2 common kinds of partnerships: limited partnerships, LP, and limited liability partnerships, LLP. Limited partnerships have only one general partner with unlimited liability, and all other partners have limited liability. The partners with limited liability also tend to have limited control over the company, which is documented in a partnership agreement. Profits are passed through to personal tax returns, and the general partner, the partner without limited liability, must also pay self-employment taxes. Limited liability partnerships are similar to limited partnerships, but give limited liability to every owner. An LLP protects each partner from debts against the partnership. They won't be responsible for the actions of other partners. Partnerships can be a good choice for businesses with multiple owners, professional groups, like attorneys, and groups who want to test their business idea before forming a more formal business. Another form of business ownership is a partnership. 2 or more people can share the ownership of a business in a partnership. The law does not set apart partners and owners, just like proprietorships. With a partnership, there should be some kind of agreement so that both parties know what they are responsible for, as well as what each gets if the business were to end. The legal agreement should include who will make decisions, how profits will be distributed, how disagreements will be handled, how partners in the future will enter the business, and what the process is for partners being bought out. Partners need to figure out how much each will spend on the business and the amount of time they will spend on the business. Partnerships can be formed with other individuals and businesses. It does not cost much to form a partnership, although tax and liability rules are different for partnerships. Think very carefully who to partner up with, since the entire company can be jeopardized if one partner makes a legal or financial mistake. Partnership advantages include: partnerships are simple to start but take time to properly grow. The likelihood of successfully raising funds increases with partners. The money made from the business goes directly to the personal tax returns of all partners. Potential employees might be more interested in the business if they know they can become a partner in the future. Partners who have compatible skills can help a business grow. Partnership disadvantages include: partners are responsible for each other. Partners must equally share all profits. Disagreements are likely because decisions are made together. Employee benefits are not all deductible on business-related tax returns. The partnership is not guaranteed to last due to one of the partners leaving or dying. There are several kinds of partnerships that can be chosen. One is a general partnership where everything is divided, which includes responsibility of management and reliability and loss or profit shared, unless otherwise noted in the initial agreement. Corporation. A corporation is a business that operates as a separate legal entity than its creators. Corporations are taxed at different rates than other business types, and a corporation may have different legal rights and responsibilities, depending on the state where it is incorporated. A corporation can enter into legal agreements with individuals and other businesses. It can be sold or have others take control of it, and it maintains most of the liability for its debts and legal actions itself. Corporations are governed by a board of directors or other governing body and typically do not have a single owner operating the business. Corporations can actually sell shares of ownership to raise funds and divide ownership among a number of shareholders. While many view corporations as large companies, smaller businesses can be incorporated as well. Corporation advantages. Owners' personal assets are protected from business debt and liability. Corporations have unlimited life extending beyond the illness or death of the owners. Tax-free benefits such as insurance, travel, and retirement plan deductions. Transfer of ownership facilitated by sale of stock. Change of ownership need not affect management. Easier to raise capital through sale of stocks and bonds. Corporation disadvantages. More expensive to form than proprietorship or partnerships. More legal formality. More state rules and regulations. Include double taxation. The corporation, as a legal entity, must pay taxes, and then shareholders also pay taxes on any dividends received. 4 factors that influence business ownership. Capital. Personal assets. Span of control. Sharing information. Capital. The main element that determines the type of business one should venture in is capital. If the individual possesses small amount of money, which one is more suitable, sole proprietorship or company? This is because the cost of forming a company is relatively high. Personal assets. Personal assets have to be taken into account. Have to be taken into account when selecting the kind of business one wants in venture in. What happen if losses happen in sole proprietorship? Liable to the creditor if losses are incurred either in a sole proprietor or partnership. Span of control. Span of control refers to the number of subordinates a supervisor has. Span of control is a term originating in military organization theory, but now used more commonly in business management, particularly human resource management. Span of control refers to the number of subordinates a supervisor has. If we decide not to share the information, so choose sole proprietorship. In partnership and company, there is no confidential information among partners and member of company. If an individual wants to have a bigger span of control and authority, sole proprietorship is the best form of ownership. Sharing information. If an individual decides not to share information with his counterparts, it is advisable for him to form a sole proprietorship. Information sharing referred to one-to-one exchanges of data between a sender and receiver. Type of sharing information is one-to-one, one-to-many, many-to-many, and many-to-one. Wants bigger span of control, sole proprietorship is better. Only sole proprietorship will have. This is because in partnership and companies, there is no confidential information the partner, members of the company or creditors. Thank you for listening in our discussion. This is the end of our topic about planning and organizing a business.